mainly because if we don't feel like there's any controls from the top, if we don't feel like there's any leadership from the top, if we don't feel like the top management cares or is hiring good people, all of a sudden now we got to look out for everything, all right? Because we know that they're not necessarily going in and getting rid of people that aren't good employees. All right, now we're going to look at the related, identify risk where things could go wrong or where a related assertion level could be a problem. Consider whether the risks are at a magnitude that would be considered material. So, like one of those risks on that questionnaire said there was a problem, but then it said it was mitigated. Or another one said there was a problem, but was that really a significant problem, or was it just a problem? We find problems all the time. I mean, I've never gone into an audit, ever, and not found a problem. You're auditing now already, right? Okay, have you ever not found a problem? Okay. It's like having an English professor read a paper and not finding a problem, all right? There's always a comma. There's always something wrong, right? There's an audit that's always going to have something wrong. It's human nature. I mean, there's going to be something wrong. The question is there going to be anything material? And hopefully the answer is no. And to be honest, there hasn't been that many audits I've been on that have had material problems. It's the other way around. There's not a lot of material issues. And usually if you go to them on the internal audits especially and say we found this significant problem, the good clients jump on it and they get it fixed because that's not what they want to find. And then what's the likelihood that this could result? So if you do find a risk, it doesn't mean it's going to result in a material misstatement. What's the likelihood that it will result? It could be a really, really big risk. You could have a huge segregation of duties problem that could result in a significant material misstatement, but it's not a problem. But it's not. So you got to look into that. All right, so the nature of our wonderful little transactions. So this is where we kind of look at how we determine the risk level. So routine transactions, things like revenue, purchases, cash receipts, and disbursements, those happen every day. They're routine, well, relatively every day, but they're routine transactions. Non-routine are things like taking inventory or things like depreciation. And then estimating are things like allowance for doubtful account. So we have to look at how often these happen, because how often they happen is also going to determine the level of risk that we associate with things and how often. Generally, routine transactions have the strongest controls. Because they happen every day, there's something that we think about every day. And because they happen every day, we know that we're sitting there going, you're the one who's entering these transactions, and she's going to review them every day. And then Andrew is going to take a sample of them once a month and make sure that they're being done. Because there are cash receipts and disbursements that happen every day, we got to make sure they're being done right. What slides under the radar is the calculating of depreciation expense. Okay. That doesn't mean anyone's taking money, because depreciation expense doesn't result in cash, but it could result in financial fraud. So that's what we're looking for. All right, so here's a few examples. All right, so what are some examples? Preparing the period end financial statements, developing significant accounting estimates, and preparing the notes. So that's an example. IT, general controls, a control environment. So this is at the statement level, all right? And then what could be high risk? Assigning more experienced staff to those specialized skills. So when you find that you have a high risk, you put experienced staff on those high risk areas. What else could you do? You could provide more supervision. If you have a high risk client, are you going to send out the brand new promoted manager and 2 entry-level staff, or are you going to send out your highly well-recognized, well-liked manager with 2 skilled staff? That's what you're going to do. You have a client that has a lot of problems year after year. You're not going to send out a newly manager with 2 unskilled staff, because they're going to get eaten alive. You're going to send out the appropriate manager for a high-risk area. You're also going to possibly incorporate additional elements for further testing and procedures if you think there's going to be some high risk, so that hopefully you can eliminate that. And then you're going to increase the overall scope. The first year that we went out to Lee Enterprises, the one that owns the Post-Dispatch, we had never seen a paper or a client set up like that. I mean, they were based out of Iowa, but yet they owned the Post-Dispatch. But the Post-Dispatch was the largest newspaper they had. The rest of them were all this, basically, do you guys remember the suburban journals? They don't exist anymore, basically. But, okay, the rest of Lee Enterprises papers were like the suburban journals. But they weren't, but they were the only paper. So, like, you go to, like, Billings, Montana, and it was, you know, the Billings, Montana Gazette. Okay, and, like, if you go down to Park Hills, Missouri, there's a newspaper down there called something. Okay, that's their newspaper, and that's the same thing. So they have those all over. It's in Utah, they're in Arizona. Their next biggest one is in Flagstaff, Arizona. And all over Billings, Montana, and other places in Montana that start with a B. I'm drawing a blank. And there's some in Illinois. And so they're all these little tiny places. And we had never, at the time, because Sarbanes-Oxley had just kicked off, Reuben Brown had never had a client that was like that. And we're like, okay, how do we go in, their corporate is in Iowa. Corporate doesn't have anything, but they do have a paper there. But that paper is like an eighth of the size of the Post-Dispatch. How do we audit these? We can't go to every one of these sites. I mean, they don't have the money. And they already were flattened, I mean, literally floored when we gave them the estimate for Sarbanes-Oxley anyways. And then and that wasn't going to all these sites. And then we found out that all these sites had their own IT. The only thing that they had in common was the roll-up GL. And I'm sitting there having a heart attack. And I'm like, so every site has their own people entering their own financials, and you don't know who's doing that and who's entering, and that anybody can, and they have access to your GL, and I'm just like, really? You know, and I'm just like, and over time they changed all that, and they got it all, but they had just purchased. And so how do we go out and audit it? How do we, we cannot go to every one of those sites. So basically what we did is we kind of put them in line from the Post-Dispatch up here. The Quad Cities was easy. We did their paper because they were in the corporate headquarters, so they were easy. And we just ranked them from, basically from financials down, you know, who made the most money all the way down. And then I looked at their computer systems along with the financials, because obviously that's more important to me than the money with it. And we kind of went like that and said, okay, we're going to go to this many. Are you guys going to have a heart attack if we go to this many? And I didn't go to near as many as the the financial people did, but I picked a hand. And that's how we're able to look at the scope, looking at the nature, timing, and then we tried to kind of fly where it's a couple of them we went like this and hit two of those little tiny papers at the same time. And we did not send a manager, a staff, and a partner. Usually I sent an experienced staff, and at the beginning, I just went. And I just did the work and went from two sites because we couldn't send two people out there. It just wasn't cost effective. So you got to look at all that when you're going, and you got to look at every client is different. Now that was internal audit, but audit's the same thing. You can't go out there and shock them, and they got to do an audit. They don't have to do an internal audit except for Sarbanes, but they got to do the audits. But that doesn't mean they can break the bank to get the audits done. So you got to go in there and help them out a little bit. All right, so assessing the level. So again, some other examples: failure to recognize impairment loss. That's going to have a big effect. Inaccurate accounting inventory at the end of the year. The valuation of inventory and the cost of goods sold is going to be off. So what's the response? All right, so here we're going to look at a combination of tested controls and substantive procedures. So looking at what we're finding and then tailoring our testing based on what we think we found. Now, those are both not good things to find, those two examples. I kind of laughed when I saw them. So we're going to go and we're going to find that they had an impairment loss and they didn't recognize it, and they're inaccurately counting inventory. So if I went into a client and saw both of those things, I'd probably be having a heart attack. But that's what we do to kind of go and look at our testing to see if that's what. Now, hopefully what they meant by that example was we're trying to make sure that doesn't happen versus that's what we found happening. I don't know. All right, so how do we decide if we're going to do more testing, and what are we going to do? So the first thing we're going to do, we're going to identify the controls that we need to test. All right, do we want to prevent or detect material misstatement? And then we're going to perform them, and then based on the ones that we identify, we're going to perform the test accordingly. I can't talk anymore. And then how are we going to determine which test? We're going to determine the test, and we're going to put them on based on how they're going to be applied. We're going to look at the consistency in which they're applied, and then by whom or how. And electronically is going to come into play here. So when we're looking at how the tests are done, can we do them electronically? Meaning, do we need to resort to the paper? A lot of tests now can be done electronically. And so when we go in there, by whom and what means were the tests originally applied? Remember, a lot of these tests are going to be done already by just the employee, meaning that these are tests that they already do. So it's not that they count for us doing them before we go, but there could already be controls that they have in place, and we're testing the control that they already have there. So what type of control is already in place? And then how can we go in and test it? We can test it by observation, or we can test it by actually physically redoing it. So in these examples, are we going to go in, how are they doing that test every day? How are they verifying every day that their invoices are matching their POs, which are matching their shipping documents? How is that being done? If it's being done on the computer through a three-way match, how can we verify that's happening? Well, probably one of the easiest ways is going to be to go through and do a sample of ones that have actually been paid, and did they have the shipping, the PO, and the invoice? Because that's going to be the easiest way because it's done through the computer. So that's kind of what they're looking at, the approach, and then the test of the controls based on that. All right, and then this is where they kind of talk about that. So the inquiries, you're going to talk to people about what they do. You're going to do an inspection of documents and reports, observation, and then reperformance. So depending on what it is, you can reperform it very easily. Other times you can't. All right, I can have them do another backup for me and come in the next day. But the easiest thing for me to do is do an inspection of the documents. Have them give me a copy of the backup logs. That's the easiest thing to do. On the financial side, sometimes talking to people is one way to do it. Other times, observation of how they're applying the controls. And then usually the two are inspection, and then I think the reperformance of the controls. What are they doing? Watching them do the actual control as they go through it. Watching them cut the check, right? Nowadays, there are still, I've seen a couple of clients still with the check writing machine, or the check, not the check writing, the stamping, whatever that thing is called. All right, and then basically, again, here this is the test of the controls. So based on the test of these controls is going to determine our substantive procedures. So we're still trying to figure out, are their controls good? All right, so there's our flow chart of our internal audit program. And do we have good internal audit control? So we flow charted it. And then how do we use the work of our internal auditors? All right, that's us, or them. Depends on how we want to do it. Now remember, back with Sarbanes-Oxley, the internal auditor can't be the same person as the same firm. All right, so internal auditor is either going to be a completely separate firm, or it's going to be residing within the company you're looking at. So you can use their work as audit evidence as part of their normal responsibilities, or you can use the internal audit work as direct assistance. So, but you cannot use the entire amount of the internal audit work as direct assistance. You cannot use it as proof of your testing. You can use it as assistance of your testing. Because otherwise, the internal audit would just be the external audit, and that wouldn't work so well. So it can just be assistance. Now, this one is, this comes into play, I can think more specifically with payroll, HR, and on the computer side. And that's with third-party organizations that you outsource to. And what you got to be careful with here is a lot of times, and it kind of mentioned this here, but it didn't, maybe it's on the next slide. You can go out and do your testing of the third party, or you can get, I think this is where it says here, or you can get a report from them. But that report should be basically a letter that they have actually been audited by somebody else. It's not just a report saying that they're okay. It's a report from a third party saying that they've been audited. So during the whole Sarbanes-Oxley, and I apologize, but I cannot remember what that report is called, and I don't know if you've done, have you done HR or payroll? Okay. But like from an ADP who does payroll, and I can't think of the other payroll company off the top of my head, on the computer side, it's companies that go do the backups. So you can have third parties that do your backups, and then you send your backups to those third parties, and they'll house them. So when they're doing your backups and they're being stored off there, they have to adhere to some internal audit or audit controls as well. They're not as many, obviously, because they're just holding your backup, so they're not having any of the financial controls. But they need to either let you come there and do testing by visiting. They have to contract with a service organization to allow you to obtain that, or they have to provide you with a report that shows that they've had the audit done. And so with the Lee Enterprises that I was talking about, the companies they had would just give us the report, and they always had it done. And they actually had a company there in the Quad Cities that did a third-party development of a software. It was very weird. I wanted to go. At one point, we were going to go audit them, even though they gave us a report, because we started feeling like we should, like they were more than, like they weren't a third party. We thought they were an extension of Lee Enterprises. So we kind of kept going back and forth on whether or not, from an IT standpoint, we should be looking at them versus them saying we didn't need to look at them and that this was, well, we never did. But I can't remember now what they were developing, but it sounded really cool. So that was another reason I wanted to go out there, but we never did. And then terms, service auditor provides an examination, use auditor uses the report. That's pretty self-explanatory. And then there's two different types of report. Type 1 is a description of the services, and it's suitable for design of controls. Type 2 is gives you assurance of the effectiveness of the controls, and it may also be used for assessing the controls below the maximum. So it doesn't take you up to the top maximum, but type 2 is usually what I was looking for on the IT side. Type 1 is just going to give you a design of control. So a lot of times it's going to depend on what you're looking for. I would imagine on a payroll side, like an ADP, that you're going to get a type 2 as well. I don't even know why. I looked at this and I meant to delete it. I'm not really sure why this is in here. It seems kind of like a self-explanatory pictorial. All right. So in the last couple slides here, it talks about management reports under, so basically when you report under 404A, you have to acknowledge a responsibility that you have responsibility for the internal controls. That is management's responsibility. That's not the auditor's responsibility. That's management's. That you also have an assessment of the internal control effectiveness as of the last day. Management has to assess to that, and you have to have support of that evaluation. Okay, that came with Sarbanes-Oxley. That was new. So that is something where management came in, and that's what caused management and companies to go in such a tizzy when Sarbanes-Oxley came out, is they were now responsible to say that they had responsibility for the internal controls, and they believed and knew that the effectiveness of their internal controls was operating as of the last day of the year. And management had to say that they knew it was okay. And I can tell you the first day that I went up to Lee Enterprises, the CIO and the CFO just looked at me like, yeah, we have no idea. And they knew that they had to say that they knew that the controls were operating as expected. And they didn't know, and they weren't. So, I mean, they could kind of tell me at corporate that they were. They had no idea. They didn't even know the names of people at all the locations. But what had happened is they kept acquiring all these little tiny papers. So they didn't even know who they were. And remember what I said about turnover? Those little tiny newspapers. I mean, they would literally have a paper boy that within a year was the person in charge of the IT. I mean, because all that the IT person did was add users, delete users, and do backup. So it wasn't a highly qualified IT, but yet they were giving them access to the servers that connected to the corporate servers. So that was a problem, you know. So that's what management had to assess. So under Sarbanes-Oxley, it said, we're having too many problems, is what Sarbanes-Oxley said. So management, you are now responsible for basically saying, you know that the internal controls are working in your environment. And you are saying that you acknowledge responsibility in your area, obviously, the CFO and the CIO, and that you acknowledge that they're working as of the last day, and you acknowledge that the internal controls are working. And that's what kind of snapped some people, and that's why Sarbanes-Oxley was such a crazy for 4 to 6 years, until people kind of got into shape and then realized that most of them could at least say, we have internal controls, and they are working, relatively, certainly. Right. But it's something that they all should have been able to say in the first place, which is why we had so much fraud going on, is because any company that got somebody with a bad nut in their head was able to do bad things because nobody was really, it was nobody's job. It was nobody's job to watch it. And that was an example at Lee. It's not that those people were doing anything bad. It just wasn't necessarily on their radar to keep it from happening. Okay, so page 283 I have marked here, so there must be a good reason.
Is it an example?
Oh, it's an example of the report to the audit committee. So that just kind of shows you the big old report. Now, this is not an audit report. We'll get to that after the midterm, I think. I think it's after the midterm. And it just kind of talks about, this goes directly to the board. Now, one thing remember in our dotted lines, the auditors report to an audit committee that should report to the board of directors. All right, that's how it should work. And like when I was at Mallinckrodt, we report, so internal auditors, we reported to the vice something of audit, who reported to the CEO, but he also reported to the board of directors. So he had both. So his main boss was the CEO, but he dotted line to the audit committee. So he always had a direct line to the audit committee in the event that he thought that the CEO was not doing something that the CEO was doing. So this right here was the CPA's writing to the audit committee of the company that they got hired to audit. So that's where the is going to. It doesn't matter who they were working for day to day. The report goes to the actual audit committee of the board of directors. And it just tells them what they found, and if they found, and in this example, they found a material weakness, and they found that deficiency to be a significant deficiency in their internal controls. So they didn't even get to the testing. They got a material weakness in the internal controls. So you can kind of figure out that if you have a significant material weakness in the internal controls, you can kind of guess you're probably going to have problems. So when you go to test, my guess is, would you want your auditors to test knowing you have a material significant weakness in your internal control? Or would you want to maybe, if you could, bypass that area of testing until you could firm up your control, maybe do the other areas of testing, and then come back, assuming deadlines, audit deadlines allow you to do that. Because if you have a material weakness, how can anything pass? To me, you're just going to be handing money over to your auditors to say, come in and test and tell me I fail. I mean, that's basically what you're going to find out. Which is why we start with testing the audit controls, for our internal controls first. All right. I'm not going to read that, but basically that's the same type of Under 404B, it's just talking about the audit approach. The approach really isn't any different. It's still the same go through, but there you're forming an effectiveness of the internal controls. And then the last slide is what we were talking about in respect to small companies. I said I was going to bring it up later. Internal controls are very, very seldom strong in small companies. They just can't be. So what you got to look for is a couple things, in that you got to have, you don't have segregation of duties, so you got to have almost like a duplication of duties. We have more than one person that's checking on what the other people are doing. So you record all cash receipts immediately. You don't leave cash receipts out, because then that's something that's hanging out there to be done later, and you don't have somebody else. It's not one person's job, so you got to have that done right away. Deposits all cash intact daily. All right, so that's being done a regular job. Make all payments by serial numbered checks without exception, with exception of petty cash. More and more companies do not have petty cash anymore. They have just debit cards for that need, and then it's tracked, which is nice. Reconcile bank accounts monthly and keep copies. So you're going to assign that to an individual that's going to reconcile, and hopefully you can make that individual not the same person who's depositing the checks or the cash. Use serial numbered invoices, POs, and receiving reports. There really should never be a time when you're not using numbered accounts. Issue check to vendors only in payment of approved invoices. So the person who's issuing a check should not be the person approving invoices. Doesn't matter how small you are, unless you're that small that you're the person who's writing the checks and paying the checks, and then you should be knowing what you're doing. Balance the subsidiary ledger with control accounts, and then do your financial statements monthly. Big companies don't necessarily do financial statements monthly, but if you're that small, you should be doing your financial statements monthly. So those are some of the controls that you can have in place. All right, now that was it. There was a problem. We're not going to do it. There was a problem in the book that we were going to do. It was 745. It was on page 298, and it talks about risk. It gives you 3 different cases, A, B, and C, and it gives you 4 different questions. And it talks about whether the controls are found to be strong and operating effectively, just operating effectively, or found to be ineffective in case A. And then in case B, they're strong, but they wish to use an old approach and not test. And then in case C, they appear to be weak. And then they give you 4 questions. I would just like to suggest that you try to answer that. I'm going to post the answers on Blackboard. But I'd like to suggest that you just try to answer that and see if you get the answers before you go and look at what the answers are. Okay, since we didn't have time to do it. Only because a couple of them aren't as cut and dry as I think you think they are. And then if you have any questions at all, we'll talk about it. And some of them, I will tell you right now, are a little subjective. I don't necessarily, when you get to question 4, I kind of argue a little bit with some of them. What you got to do there is lowest, low, moderate, high, and highest. You got to rank them. I kind of vary a little bit on what I would consider. So if you're thinking it's moderate, then they say high or low, but you're kind of right in there with it. You could be right in there with it. I mean, it doesn't mean you're wrong, all right? A little bit subjective. But if you say it's lowest and they say it's high, you might want to figure out why you're different on that one, because I wouldn't expect them to say it low when you're thinking it's high. There could be a difference of opinion. I don't think that's just a difference of opinion. So, okay. So let's talk a little bit. We're going backwards. Chapter 5 is next week. So next week is like what we had before, okay? So you have Chapter 7 homework. That is due next Thursday.
We already did chapter 6. It was chapter 6 that we did homework for.
We just did Chapter 7, though.
Yeah, but we did, how did we do it? We did 1 and 2, then we did 5, then 3 and 4, now we did 7, and we're doing 6 after that.
Right, but I'm saying chapter 7's homework is due
yeah.
next week.
Yeah.
Right,
Yes.
okay,
And then
that,
it's-
right, then we're going back to 6.
Okay.
Right, okay. I'm already confused enough.
You
All right.
said 5.
Oh, I
Yes,
said 5,
already.
I'm
Yeah.
sorry, okay. So chapter 7's homework is due a week from today, like normal. And then the next week, we don't meet Thursday, the next week is chapter 6, which is risk assessment. And so you'll have its normal homework, and then you have a case. And so the case, I have copies for you. It's also posted on Blackboard under cases in case you lose the case. Since it's not in your book, I don't want, in case you don't have it. Oh, you already printed it? Okay. So it's a lot of reading, but it's a lot of reading, but it's not that I mean, I don't think it is. You guys will have to tell me for some reason I'm wrong, but I don't think it's that huge. So it goes through first, and it talks a little bit about just the PCAOB auditing standard 5, and it explains the summary, and then it's going to go into talk about this specific case, and it's going to talk about order processing, shipping, and invoicing about this company. And then I did include the 2 little handouts it's talking about on the back. It's a flow chart, okay? So you get to look at the flow chart. And there's 3 steps. It wants you to talk about the relevant controls that address the risk in the order processing sub-process, and then what relevant controls identified would address the risks that goods are shipped to customers but no invoice is generated or recorded. And when considering the audit procedures outlined in the POCAB Auditing Standard 13 and Standard 15, describe the nature of the audit procedures or combination of audit procedures that may be performed to test the operating effectiveness in the question identified in number 2. So it's going to have you go through that case and kind of, in some ways, I guess it might be. It's going to be a smaller write-up than last week because you had 2. But I'm not sure it will take less time. I'm not really sure because it's more reading. It might be a little bit more lookup than you had last time because last time was a little bit more judgment. So I am curious. I never did ask you how long last week's cases took. How long did it take you to do the ethics and the litigation? Were they both about the same? Did one take more than the other? Because
Slightly longer than the second one.
the second was longer than the.
There was more reading in the second.
That's the first time I've done both of them, so I'm trying to figure out like how much is too much. You know what I mean? Like, was it?
I mean, with the ethics case, you kind of have to just give opinion.
Right.
So it's more just writing it down. While with the litigation, you really have to do more about it.
To look it up.
After more supplemental.
Right. Okay. Well, when you do this one, just kind of let me know as well, because this one is a true, like, educational case that I went out and found. So I'm just looking. I know how long your internal audit report one takes when you do that, but this one, the one you're going to do next, and those 2, those are all new. So I'm kind of just trying to see what workload I'm giving you so that if I need to make changes next time, I know what changes I need to make too. So, all right, I didn't kill you, in other words, you were fine. Should I give you more? All right, that's it. I guess we'll see you in 2 weeks, and then if for anything on this comes up, let me know. And then when we meet next time, then that's it before your midterm, because we talk about IT controls at the next one.